Ladies and gentlemen, welcome back to today's show. I'm your host, and as always, we're going to cut straight through the noise and dig deep into the harsh economic realities we're facing today, just as we've watched unfold again with the UK's latest announcements about their precarious financial position. If you've been paying attention, you're probably already familiar with the latest warning from none other than the International Monetary Fund, IMF, which is signaling loud and clear, chaos is coming if the UK doesn't get its financial house in order. And this time, it's not just a vague warning. They've got specific numbers to back it up. So what's happening here? Let's break it down in a way that everyone, from the seasoned economist to the average taxpayer, can understand. We've got UK Chancellor Rachel Reeves, set to deliver her first budget on October 30th. She's essentially been handed the steering wheel of a sinking ship, and the IMF is warning her that without quick and severe action, UK debt risks spiraling out of control. To put it bluntly, this isn't just a little nudge to be cautious. The IMF report directly states that debt risks in the UK are elevated, and failure to establish credible plans to manage this debt could lead to an outright market meltdown. We're talking about panic in capital markets like what we saw with Liz Truss's disastrous 2022 tax cut debacle, which nobody has forgotten. At the heart of this issue, we're seeing some cold, hard numbers. UK debt is at 100% of GDP, the highest it has been since 1961. That's right, folks. We're talking post-World War II levels of burden, placing tremendous pressure on the national economy. And unlike then, the UK isn't in a rebuilding phase with economic fundamentals to lean on. Quite the opposite. Today's economy is burdened by stagnation, lower productivity, Brexit-induced trade disruption, high inflation, and slowing global growth. Already, investors are expected to absorb £138 billion of gilts, the government bonds that finance the deficit. And that's just for the current year. Think about this for a minute. The UK economy isn't growing fast enough to support this kind of massive borrowing, yet Reeves is looking at potentially adding a further £53 billion in borrowing capacity by altering debt measurement. Why? Well, it's simple. She needs headroom to invest in growth. But what's that going to do? It's already clear that markets have limited appetite for new debt. The patience of investors, as always, is scarce. Now, let's make this crystal clear. Debt itself isn't automatically a bad thing, if used wisely. When you borrow to invest in infrastructure, education, and innovation, you can create long-term growth. But when you're already deeply in debt and the future growth prospects are uncertain, that's when things start to get dangerous. The IMF isn't just giving a vague warning. They're saying that Reeves has to somehow find savings worth 4.5% of GDP. In practical terms, that's about £110 billion that needs to be shaved off the budget over the medium term. And they're not saying this just to be dramatic. The IMF analysis lays out that this is what it's going to take to have an 80% chance of preventing the debt from rising further. For 0.5%, folks, that's not small. That's austerity-level cuts we're talking about, potentially even deeper than what voters were subjected to after the 2008 crash. The proposed remedies also aren't exactly bread-and-butter fixes. The fund has suggested both tax increases and spending cuts, which will undoubtedly face resistance not just in the political sphere but from the already cash-strapped public. Let's think about the real-world consequences of raising £110 billion worth of savings. Tax rises and spending reductions at this level will directly impact the living standards of everyday people. We're already hearing the Institute for Fiscal Studies warning that $25 billion needs to be found just to give a real terms boost to public services. Let's pause on that. Public services are already deteriorating. The NHS is on its last legs. Waiting times are rising, staff shortages are rampant, and public morale is cratering. Labour has already said they plan to introduce around £9 billion in new taxes, while trying to cut about £1.5 billion from winter fuel payments. That barely even scratches the surface, and given the state of inflation, hovering around 6 to 7%, it's safe to say the cost of living crisis is going to stick around for a long time. People are already feeling squeezed from inflation, and further austerity will make the situation worse. That's why any tax hikes or cuts to social services are like pouring salt on the wounds of the middle class and lower income groups. Now, don't think for a second that the UK is alone in this mess. When we look at other major economies, countries like Brazil, France, Italy, and South Africa, they, too, are struggling with rising debt-to-GDP ratios. Even the US, the world's largest economy, isn't immune. Public debt is a global problem right now, with seemingly no easy solutions. However, what makes the UK unique is its reliance on borrowing to fund basic operations combined with heightened post-Brexit uncertainties and the scars from the global energy crisis. For example, Italy and France are challenged by aging populations, while presidents and prime ministers are battling similar fiscal pressures. But at least France has the EU as a backstop, and Italy is currently benefiting from the European Central Bank's financial mechanisms. Meanwhile, the UK, post-Brexit, is sailing alone, exposed, relying on foreign markets to fund its debt. Just a year ago, when bond market confidence evaporated after Truss's ill-timed tax cuts, the Bank of England had to intervene to prevent an even worse catastrophe. So, is there any hope here? Can the UK avoid disaster? Well, Reeves has a tightrope to walk on October 30th. She's already signaled that she's going to make some tough decisions. These could range from developing new revenue streams, such as cracking down on wealthy non-dom foreigners, which, by the way, isn't a panacea, as it may only bring in a fraction compared to the amount of debt in question. She's also likely to try to balance between loosening fiscal targets to gain some headroom and try not to spook the markets. Let's also not forget the issue of economic growth. Many are calling for investment in areas like green technology and infrastructure as a way to boost productivity, possibly increasing future GDP and bringing the debt metrics back into balance. Though the bottom line is, none of this happens overnight. Investment takes years to bear fruit, and markets can react violently in the short term to the uncertainty of such policies. Looking long term, the risks the UK faces aren't just a radical market blowout with a sharp spike in bond yields causing immediate panic. There's also the slow death, the gradual erosion of confidence in the UK economy in the global financial markets. Interest rates on debt could rise slowly, crowding out public investment. This would mean more taxpayers' money going towards servicing past mistakes, leading to even more belt-tightening, even less room for growth, and a potential lost decade of economic stagnation coupled with rising inequality. Is this exaggerated? Not at all, because historically, high debt levels paired with low growth tends to weaken economies step by step. Japan, for example, has been suffering stagnant growth for nearly 30 years under a debt load surpassing 250% of GDP. While Japan's peculiar economic situation comes with unique cultural and structural factors that aren't directly comparable to the UK, it's a reminder of how serious unchecked debt can become. And let's not downplay the threat of inflation, remaining elevated for the foreseeable future due to supply-side pressures, oil prices, and wage demands. Access to cheap credit is no longer guaranteed, and inflation ignites a vicious cycle of eroding disposable incomes and sparking higher demands for safety nets. Networks that are increasingly expensive for the government to sustain. All right, people, this is as real as it gets. The UK stands on the brink of either making hard, painful, but necessary corrections, or kicking the can far enough down the road until the entire fiscal structure collapses, possibly triggering broader global financial instability. There are no easy ways out, which is probably why Rachel Reeves is bracing herself to present a tough budget at the end of this month. Whether you're an investor, an economist, or just the average citizen worried about your pension, groceries, or healthcare system, now is the time to pay attention. Does Reeves come in with the steady hand that inspires confidence? Or does she risk pushing the patient deeper into the hole? Only time will tell. But mark my words. The warning signs are loud and clear, and ignoring them would be a disaster waiting to happen. That's all for today. As always, leave your thoughts in the comments below, and make sure to subscribe and ring the bell for the latest on financial developments. This is Boss Economics World, signing out until next time, where we'll continue to break down the world's most complex economic issues and see if anyone in power is really paying attention.